The Bank of England have cut interest rates for the first time since 2020. But the big question is this the start of more to come, or will interest rates remain close to 5? Now, the bank claim it is currently a finely balanced equation. There are 5 good reasons for further interest rate cuts. Firstly, headline inflation has fallen to the government's target of 2%. Secondly, despite exiting recession, economic growth forecasts are still pretty anemic. The IMF forecasts just 0.5% for this year and 1.7% for next year. That's still well below the long-run trend rate of economic growth. Thirdly, the pound sterling has ironically been one of the best performing currencies in recent months. This will help to dampen domestic demand and reduce imported inflation. Fourthly, real interest rates, that's the nominal interest rate minus inflation, is currently 3%, and that is very high by historical standards. And this rate of really high real interest rates has been a factor behind the growth in the savings ratio. Fifthly, in both the US and Europe, there's similar talk of interest rate cuts, as it appears that the global inflationary pressures have been diminishing in recent months. Now, on its own, that actually presents quite a strong case for more interest rate cuts to come. But the hawks in the Bank of England will point to other factors which make them reluctant to cut interest rates much more. Firstly, although headline inflation has fallen to 2%, it is likely to go back up in the autumn because it's come down because of falling energy prices, but these will fall out of the index in the autumn as energy prices go back up. Secondly, and perhaps quite importantly, there's still fairly significant evidence of strong nominal wage growth of at least 4 to 5%. And this feeds through into inflation because firms have higher costs, consumers, households have more to spend. And this helps to explain why service sector inflation has been pretty stubborn at 5.7%. And the banks seem to be giving a lot of weighting to this service sector inflation. And it suggests that the headline inflation rate of 2% is somewhat misleading to what's really happening in the economy. Another factor is that the new government may well be more ambitious in improving economic growth. They talk a lot about building more houses and encouraging investment, so this may boost economic growth and need interest rates higher. Although having said that, I'm not convinced by this point because, recently they said because of the black hole in finances, they're going to cut back on public sector investment. It's not quite austerity 2.0, but it's not far off. It's certainly nothing like the US-led fiscal expansion we saw in the past 2 years. Another factor is that some optimists may argue that the UK's recovery has been better than expected. It's been slightly stronger, suggesting that high interest rates did less to dampen demand than you might expect. The housing market has perhaps been more resilient than many feared, with prices kind of holding up and signs of renewed activity. On balance, I think there's a stronger case for future interest rate cuts. Forward indicators of wage growth suggest that wage growth is slowing quite sharply. Now, when headline inflation rate falls like it has done in the past 12 months, it's only a matter of time before firms catch up and reduce wage growth pressures. Now, workers in the UK have relatively little bargaining power, and certainly there's no productivity growth to justify big wage increases. Now, of course, there is a time delay of up to a year before the fall in headline inflation is reflected in lower wage settlements. And I think it is worth pointing out that the government's public sector review that they've accepted of 5% will help wages in the public sector keep high. But I think overall, you're likely to see wage growth pressures come down in 2025. UK unemployment has actually ticked up in recent months from 3.6 to 4.4%. And for Taylor Swift fans out there, there's even an argument that recent inflation would have been even lower if she hadn't had her UK tour. One of the biggest increases in inflation last month was actually in the hotel sector, an indication of unexpectedly high demand. Certainly other countries claim there can be a Taylor Swift factor in causing an inflation spike. We'll have to see. We'll have to wait until autumn to see whether that's true. The final point is that it's certainly true some in the economy have done well from high interest rates. It's been great for savers after a decade of pretty poor returns. But on the other hand, those with mortgages and those with personal loans have been really hard hit by the very high real interest rates. And don't forget that as people remortgage onto new fixed rate deals, the effect of the past interest rate increases will have a continued effect throughout the next few months, even if interest rates come down a little bit. Now, what about interest rate forecasts for 2025, even 2026? Well, at the moment, the consensus is for a fairly modest cut in interest rates next year. The Times report 4.5% by the end of the year, 4% next year. The IMF are a bit more optimistic on rate cuts, saying they could be 3.5% next year. But as I like to point out, the recent history of interest rates show that forecasting can be very difficult when you start to do it in the medium term. If you go back to 2007, nobody predicted 13 years of near zero interest rates. And when interest rates did fall, there were many predictions interest rates would soon go back up, but we had 13 years of forecasts proving inaccurate. So a really interesting question is there any chance we could go back to that period of the 2010s when interest rates were near zero? Now, the argument is that we've entered a new era of economic stagnation, secular stagnation, aging population, falling investment, lower consumer spending, all causing this very low growth and low interest rates. Now, others claim that was actually an unusual experience because in the 2010s we were recovering from this unique event of a credit crunch where balance sheets got absolutely decimated, and it took so many years to kind of recover from that financial wipeout. I think that the chances of going back to zero interest rates look less likely than they did a year or two ago. There does seem to be some signs of stronger growth, especially if you look at countries like the United States. And there'll be a hope that some of the new technology and investment in renewables will help boost higher growth. Even if it's hard to see a return to the post-war trend rate, there does seem to be prospects of escaping that cycle of economic stagnation. But equally, in the midst of a COVID pandemic, when interest rates were 0.25%, very few could have foreseen the dramatic rise in interest rates that happened over a short period of time. So a big question always is there any chance of a return to some cost-push inflation? And of course, this is one of the unknowns, but with many geopolitical uncertainties, there's always a chance that we could get a renewed surge in oil prices or inflationary pressures, but it's very hard to predict. The rise in sterling is certainly interesting, though as this video makes clear, quite a bit of it is due to actually some economic problems in the UK. So if you're interested in learning more, do check this video out.